Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. I'm Gary Wilson, your host, and I'm glad to have you back. If you wouldn't mind doing so, if you haven't already done so, is please subscribe to the podcast. It's on 30 different channels, including the biggie Apple, but you choose the one you want. And while you're online doing that, please visit globalinvestoragent.com for investors. Remember, I'm an investor too. This is where you'll find trained investor agents. They have to have a certain certification. They're not necessarily commercial. They're working with typical mainstream America, dentists, engineers, teachers, pilots who are doing flips and fourplexes and things like that. The bottom line is this: they're not typical agents. They're trained to work with you and I. They know how to identify, analyze, and negotiate on and off market deals using some really cool tools that we developed for them over the years. So in any case, do that. And if you are an agent and you want to participate in this and learn how to invest by working with other investors, you definitely want to click on the Learn More button, and we'll talk to you and see if this is a fit for you, because the market is changing, right? And you do not want to fool around. It's not the kind of thing where you wait and see. You want to prepare, right? So, in any case, without further ado, we got a great guest, Chad Zdenek. Did I pronounce that correctly, Chad?
Close, Zdenek.
All right, Zdenek. Okay, thank you very much. I appreciate that. Chad, thanks for doing this, man. I know you're a busy guy. I've read your bio, and we just had a great conversation. So I feel like we're pretty privileged to have you on board today. So thank you.
No problem. Glad to be here. Thanks, Gary.
Yeah. What's interesting is our backgrounds are so much similar, and I'm always excited to meet someone like you and see what your path has been like. So if you wouldn't mind, let's just go ahead and start at the beginning. Where were you? What industry did you break into? And take us through that pathway to getting into real estate, if you don't mind.
Sure. Yeah. So I've kind of had three distinct career paths. Been wandering a bit, but they've all played a big role into where I'm at today. So I actually started out as a civil engineer and started working for a Boeing Rocketdyne on the space shuttle main engines. I think we both did some time working on the space shuttle main engines, which was an incredible experience. I did that for 7 years as a cubicle jockey, right? It wasn't 9 to 5. It was more like 7 a.m. to 4 p.m., but 7:15 meetings every day on site, couldn't work from home. And did that for 7 years, really enjoyed it. Great group of people, super brilliant people I got to work with. I started working there kind of young. I was 21, so definitely the youngest guy on the crew there. But then I was always very entrepreneurial. So I happened to be getting my MBA over at UCLA at the time. And coincidentally, both my brothers were playing football at UCLA the same year I was there. So 1 year, three brothers, all of us were at UCLA. And my brother started a lighting business, and I kind of used it as my pet project because I was focusing on entrepreneurial studies and doing some consulting for him on helping to grow and scale the business, implement systems that I know you're a big fan of as well. And the business started to grow, and he really wanted me to come work with him. But I was doing really well at Boeing. I was on the executive management track. But anyone who's got siblings that they're close with knows it's pretty tough to say no to that. And I was always an entrepreneur at heart anyway. So I actually took the leap and went over to go work with him. And it's interesting how it worked out because he offered to pay me more than he was paying himself, gave me half the business. But I wound up having to take a 50% pay cut to go work for him. So it was definitely a meet in the middle type of situation. But we worked this lighting business. It was primarily Christmas lighting. I had a lot of my engineer friends made a lot of fun of me, and the family was confused about what I was doing, but I was chasing my entrepreneurial dreams. And we wound up growing that business to a 75 employee company. We had 3 different warehouses. We're the largest company in LA doing what we were doing. And it was great. I did that for just over 15 years. And then felt like I couldn't get past that ceiling of a seasonal business. It was really difficult to continue to grow. So I decided to make my third pivot, which was into real estate. And I like to call it going back into real estate. This was in 2018 now. And because I was doing construction management beforehand, I'd got my contractor's license. I got my professional engineer's license in civil engineering. So I was very involved in real estate from like the transactional design aspect, but never as an investor. So I really wanted to get into investment because I'd met a lot of people that had been successful through real estate investments over time. And that's what I did in 2018, went into real estate full time, went basically straight into, I did 2 investments on my own in 2015, 2016, while I was still doing the lighting business. But then by the time 2019 came around, I syndicated my first deal as a solo GP, bought a 10-unit apartment building here in Long Beach. And that was my first syndication. And then I was off to the races, and 5 years later, I've got close to 200 million under management now. And I've got maybe 750 multifamily doors and about 2,600 self-storage units. So those are the 2 asset classes I focus on now. And it's been a wild ride for sure, but I really love real estate.
Yeah. Well, what's interesting is if you've got a great story and a great life history, and the fact that you're in California, in the LA area, and investing is equally impressive. I spent a lot of time out there myself. I mean, I haven't been there since before the pandemic. I need to get back out there, but usually I'm out there every other year for about 5 or 6 months. I've got family out there. And What's cool about it is people who are not from California think you really can't invest in California, but you can. Everything's relative. Like you mentioned Long Beach. I have a couple of friends out there that have invested there, and they would buy one property they bought, I think was a 23 unit. They bought it for like 2.3 million and sold it 2 years later for, I think, double, or more than double, I think 5.6. And then you've got the little area called San Pedro that's not too far from Long Beach, and that was up and coming. Palmdale's up over the mountain ridge, but heck, I'd make the drive for those deals. And then you got Temecula and Redlands and Riverside way out, out towards Big Bear and all that. All great areas, but let's face it, LA, things keep going up and people still rent. In fact, West Hollywood, the last time I was there, was 82% renters. That means 82% of the housing stock in West Hollywood was owned by investors.
Yeah.
And some of the most expensive real estate on the planet, and yet people are making money. So it is all relative. Let's jump into that a little bit. I know you talked about syndicating, and you mentioned multifamily and storage, but tell us a little bit about the multifamily. Like, what's your strategy for identifying and analyzing, negotiating those deals? Is some of them on market, some off market? I want people to really hear that you can invest successfully in the LA area in spite of what people fear, so.
Yeah. And I should preface it by saying I also have some more recent fears because of what was happening during COVID and the eviction moratoriums and rent freezes. So I actually made a pivot partway through COVID to investing out of state. So I still run my properties here in California. But it's been challenging. I mean, you look at LA City still has a rent freeze going on right now. And we're filming this in May of 2023. And here we are 3.5 years in on this thing. And there's been a rent freeze this entire time. And it actually isn't set to expire until February of next year. That's assuming they don't extend it, right? They extended the eviction moratorium probably 6 times. That just got lifted 2 months ago. So there's some serious headwinds here, and I call them political headwinds, right? These are things that are coming down from Sacramento, some things from LA City Council that make it very, very challenging to underwrite that sort of uncertainty into your underwriting, right? You just don't know what will happen or when the rent freeze is going to end. So, and for me, that there's too much uncertainty there to model something like that for my investors. So we're actually investing a lot more in the popular states like Florida and Texas, North Carolina, and doing really well out there. So for me, it definitely is a mixed bag. But to go back to your original question about underwriting, how do you underwrite it? So you can't, in my opinion, actually, it's not even really an opinion. You can't underwrite that level of uncertainty, right?
Right.
Legislative uncertainty. So you have to take some of that on risk. You would need to have, higher operational reserves. And the debt requirements are pretty strict there from what the bank's going to require you in terms of interest reserves. You're going to want to have low leverage, right? You just have to be very safe with it, which is going to hurt your yields. You're going to have lower cash flows, but it's LA and equity happens. So generally speaking, it is going to go up. And there's not a whole lot more places to build. Regulation is super high, so it's very difficult and expensive to build. So all of that works in favor of the investor in terms of on the equity side, right? But if you're investing for cash flow, it can be a little bit challenging. So that's kind of the California type underwriting.
Okay.
Out of state, it's a lot more certain, at least in the markets we're investing in, a lot more certain of what you're going to be getting, how to handle it, how to handle evictions if tenants aren't paying and that sort of thing. You do have, and I do a lot of value add deals, right? So basically rehabbing, remodeling. You could be doing additions or stuff like that, which we don't do. We do the heavy remodeling, but you do have uncertainty like with supply chain issues or labor issues, right? You still have those sort of issues, which are really seen nationally, not just here in California. So those are challenges. So basically, on an underwriting standpoint, you'd basically built in, like if you're doing a rehab, you'd build in longer lead times to getting your supplies, longer lead times to finishing construction. You'd have higher reserves in terms of your CapEx budgets. Right. If you might have had, 5% on a really large project before, maybe 10%, maybe you'll do 15% now to account for some of these overages. If you want to be really conservative, maybe you'd have 20%. And then you'd also assume that those rents are kicking in later, right? Let's say you think that you can get it done in a year. Well, you might underwrite that to be like 15 months or maybe 18 months on the outside. And assume that you can't get those rents for a lot later. And the reason why you got to do that is you really got to make sure that you can cover your debt in the meantime, right? Mm-hmm. So when you're doing these unit turns, not only are you spending money on them, but you're not getting the rent. So you need to make sure that you have that built in your budget, because you don't want to be bumping up against any of these debt service coverage ratios or any of the lender caveats or requirements, the covenants. All those sort of things that they check on at least annually, even more so if it's a tighter deal, but at least annually they're going to check these things. And if you run into hot water, you could have a capital call from or margin call, if you will, from the bank, and they're going to say, "Hey, you need to increase your reserves this much," and that's never a fun position to be in. So it's better to be conservative up front so you don't run into any of those issues.
Yeah, well, I really appreciate that too. And since we talked about it, you mentioned that obviously there's turmoil in the world, not just what was happening during the pandemic with moratoriums and the forbearances. By the way, on mortgage payments only applied to owner occupants; it didn't apply to investors. So we were told we couldn't evict people to collect rent. And yet we still have to pay mortgage payments. It's really tough. But in the world, generally speaking, and there's other factors. I mean, there's some good things and some not so good things. But where do you see things going with the housing market relative, or what are you seeing in the world right now that would impact the housing market? And where do you see that market going? We'll be right back with the Massive Passive Cash Flow podcast after I invite you to Monday Night Live. Every Monday night, 7 p.m. Eastern, I teach a class without fail for you on subjects ranging from flipping to buying rentals, managing rentals, wholesaling, commercial, creative purchasing techniques, analyzing properties, identifying properties, hundreds and hundreds and hundreds of subjects. And if you are a licensee, if you have a real estate license, you should definitely tap in, because there are a lot of investor agents also in the class. Many of them are on the global investor agent team. So you can learn from them as well as from me how to actually work with investors correctly and profitably. All right, we'll see you Monday night. The link is in the show notes. Go ahead and register. We'll get right to the Massive Passive Cash Flow Podcast.
Yeah, look, that's the $1 trillion question that everyone is focused on trying to figure out answers to, and there is no right answer. You know, there's a lot of speculation. I was just at a conference, a macroeconomics conference, which I focus a lot on, last weekend in Orlando. It was George Gammon's event, Rebel Capitalist Live, and hearing from people that really focus on the macroeconomics. So right now, interest rates are the big question mark, and the big driver right now for real estate, right? So what's the Federal Reserve going to do with interest rates? That's the big one. In my opinion, they're gonna pause. They might go up another 25 basis points the next meeting, but in all likelihood, that's going to be it, in my opinion. If I had to guess, I'd say a 60% chance they stay at zero, but I think they're going to hold here for a while. I think it's going to be different than it was in the late 70s, early 80s, where you had these, three big swings, big spikes up to 18%, 20% rates, and then all the way back down, and then all the way back up. I mean, they were doing, 10% swings to try to get inflation under control. Yeah, I don't think we're going to see that this time around. I think what they're going to do is they're going to keep it. You call it high right now, but really we're at the 40-year average, right? So anyone who's been investing for a long time, I know you know this, is like we're back to normal, right? It's not exactly high relative to where we were, a couple of years ago, but it is more or less back to normal. So I think they're going to hold here for a while. And the challenge, they want to hold here to try to bring inflation under control. And the challenge with that, when it comes back to the real estate market, is a lot of these loans, bridge debt loans, something like 80 or 90% of the loans have been bridge loans, which means it's a shorter term loan, maybe 3 months, and you're trying to get to 3 years. Hold on. It's a 3-year term. It's a bridge loan to get to longer term financing, right? Mm-hmm. And the longer term financing might be 5 or 10 years for a commercial loan. Well, the problem is these bridge loans, and it is done so that you can do the value adds or whatever you're doing to the property. And but the problem is it resets, right? You don't know where you're going to be at 3 years. So when the underwriting was done, going back to your original question about how do you do underwriting, like if you're having an exit on a bridge loan, you're assuming some sort of refinance event at that period, and you're assuming some sort of interest rate. Well, most of the people that were underwriting these loans, including the banks, were okay and accepting that maybe you were at a 4% refinance rate or 4.5%, somewhere in there. And you're not there, right? You're at 6%. So that's a big swing, and that's a big problem. So we've got about $1.2 trillion worth of commercial loans coming due in the next 12 months. Most of those were underwritten to lower interest rates, and they're not going to be able to get the loans that they originally wanted. And those are the distressed properties that are going to be coming up for sale, and it's going to cause some downward pressure for sure on pricing. That being said, there's also the other side of the equation, which is the supply side. And we still have major issues from the great financial crisis, where we were undersupplied for the better part of 10 years before we caught up to our 40. And we're short on inventory now, depending on how you look at it, anywhere from 2 million to 5 million units. And that's creating extreme upward pressure on pricing, right? And to go back to multifamily, which is the main asset class that I invest in, we've seen tremendous growth in rents in large part because of that. So you're gonna have like these kind of opposing issues, interest rates being a big one, supply issues being another issue, that are kind of opposing each other. and then the Federal Reserve doing what they're going to do with interest rates. It's a dynamic time for sure.
It is. It just goes to show you. I mean, every market cycle, the fundamentals are always the same. I mean, supply and demand is like the sun rising in the east and setting in the west. So you can't fool Mother Nature and you can't fool supply and demand. But in real estate, what's interesting is there's often a time delay. So it's like a seesaw. Demand goes up, supply goes down. Demand goes down, supply goes up. But there's a time delay there, and it freaks people out because they hear this stuff on the news, and yet currently today in their pocket, we call it the pocketbook test. Everything's okay, and I'm able to go out and eat dinner, and everything seems fine. So they get lulled into complacency, and all of a sudden, consumer confidence will eventually catch up, and that the upward pressure on borrowing money, that the cost is going to dampen the demand. It's just a mathematical certainty. We can't tell you when. All the gurus on the planet would all say, gee, I wish we could tell you exactly when, because if we did, we'd all be billionaires, but we just can't do that. The one odd thing that I'm seeing, or it's actually two odd things, is one of them started in California, up in the Bay Area. There was a great idea to address the shortage of affordable housing, which is, of course, incentivize the investors, developers, builders, investors, to build affordable housing. In order to incentivize them, they're offering them, guaranteed rent payments. Well, there's a catch to that. The catch is you can't refuse renting to somebody for financial reasons, which is the one reason we always use to either let somebody in or not let them in is can they afford the place? And if you can't use that, I mean, it's like a protected class. Well, that any investor, anybody that understands, human nature and math, going to say that's not a good deal. So they really didn't address the problem. The other thing is they're not even addressing the core problem. They're creating a renter base when they should be working on a home ownership base. I mean, California, I think, is now above 45% rentership statewide. It's just crazy. Then the other big thing is, and I didn't believe it when I first heard this. I was at a conference, ironically, also last week in Orlando, and somebody said, "You understand what the administration is doing now with loan? What they're saying is, if you have a high credit score, historically you would get the best loan rates and terms. Now they're saying they're going to require the lenders to give the people with the higher credit scores the higher interest rate loans, and then people with low credit scores give them the lower interest rate loans to help those people out." And I know you know the answer here. That's not the answer. It's a short-term Band-Aid. I don't know if it's to get votes. I don't know what they're doing, but what universe is that logical in? Because think about this. Now they're going to allow more people that probably should not be getting these loans, getting loans. If they aren't responsible enough with their credit scores, what makes them think they're going to be responsible just because we threw them a new mortgage? Not going to work. You're going to have more people in foreclosures. And then what are they going to do? They're going to put another forbearance in on foreclosures. And all they're doing is creating a bigger problem. And you can't keep doing that. Eventually, the money's going to run out. The other country, China, is going to say, we're no longer interested in investing in U.S. property and buying U.S. bonds. And by the way, we want our money back. We want to sell the ones we've already got. That's going to be trouble. So sorry to get off on a tangent here, but there's a lot at stake in the world right now. And I do agree, if you can own some real estate, folks, I would encourage you to do it. Just do it in the right states. So let's talk about people trying to get in the business. We're probably just scared the crap out of them. But the reality is between food, shelter, and clothing, everybody needs a place to live. That's the shelter part. Yeah. That's what we do. And that's why a lot of China's bought up a lot of properties in the States. That's why Warren Buffett said famously in 2011, if I could buy 100,000 single family homes, he would do it. Well, he didn't. He bought Prudential Realty. Maybe it became Berkshire Hathaway. But also Bill Gates is buying up land like it's going out of style. I mean, I think he owns now close to 300,000 acres across the country. And he just tells people, we ask him why, and he says, well, because my financial advisors say I should do it. There's more to the story. Hedge funds are gobbling up real estate like it's the last real estate on the planet. So I'm trying to preface this, but what can you tell new investors out there? What kind of advice can we give them and to help them just to get started?
Yeah. Yeah, so that those are all really good points, right? And one of my favorite lines is that real estate is the best get rich slowly scheme out there, right? It's like, when's the best time to buy? 20 years ago and today, right?
Yeah.
Today is the best time to buy if you have a long time horizon, right? So you can't it's easy to get caught up in the minutia of the kind of the day-to-day details and macroeconomics and that sort of thing, but if you have a long-term horizon and you have a backdrop of 90% of the world's millionaires have some of their portfolio in real estate, like, to me, that, follow the money, right? Real estate is a very, very powerful tool. And in the beginning, we talked about my meandering path, right? Between, being a cubicle jockey, rocket scientist guy, to a business owner, to now real estate investor. Like, I think I found out where I finally need to be. And for me, long term, that's the play, right? And we haven't talked much about passive income, but that's really what I've been chasing is passive income. So for somebody who's looking to get started, I'd say, you definitely want to have real estate in your portfolio. You probably don't want it to be 100% in your portfolio, but you definitely want real estate in your portfolio for long-term appreciation, right? You also have tax savings along the way, and you can get some passive income too. So there's some really, really big benefits there. I think the easiest way to get started is, and we talked about syndication a little before, which might be a new idea or term for some people, but to start out as a limited partner or limited investor, right? Meaning you've saved up some money, you want to start learning about real estate, or you want to invest in real estate. Like, you can do that as a limited partner inside of somebody else's deal. And these syndicators are basically the quarterbacks of the team that pull the whole team together to purchase a larger property that you wouldn't be able to do on your own, or you just wouldn't want to do because you put too many eggs in one basket, right? You don't want to own just one property. You want to spread your money out. So a great way to do that is through a limited partner investment into one of these deals. And it can start out, as low as $50,000, might be $100,000, somewhere in that price range is generally what the minimum is. And you can kind of pick your asset class, you can pick your state, pick your location, and then you learn a lot from doing that investment. You're following it, hopefully you're investing with a syndicator who's got really good communications and keeping up to speed on everything. And through that process, you can learn a lot about real estate and earn some passive income along the way. I think that's a great way to do it. Okay,
Right.
so
There was some background noise.
okay, no problem. So that's one way to do it, right? Another way to do it is if you wanted to do your own investment. And a lot of people will start out, maybe they'll buy a short-term rental, Airbnb type of rental. Maybe they'll buy a single family home. Maybe they'll buy a duplex or a quad and they move into one unit and rent out the other units, right? That's a much more active way to do it. The syndication way was the passive type of approach. The active type approach would be like buy your own small property, right? The third way, if you're really ambitious, which was my way, is I syndicated a deal myself, right? And I basically got 10 investors together, and we bought a 10-unit building and fixed it up. Now, excuse me, I was the guy who's in charge of everything as the general partner. They still were limited partners, but you could do my type of approach, or you could be a co-general partner with another team and follow them and invest alongside with them. Either way, you got to tie in with someone who's got experience if you're doing the active deal, working with other people's money, especially when you start dealing with the SEC and some other compliance issues. You really got to make sure that you know what you're doing. But by joining mastermind groups and things like that, I know you mentioned you're looking to start a mastermind group. I mean, that's a great way to learn about the business and then take your first step into it.
Yeah. Yeah, you're so right. I want to touch a little more on the syndication. We got into that out of discussion of new investors and what can they do, and it's a great way for them to put their toes in the water, like put one foot in, learn the ropes, see how it all works, and then they can maybe buy their own properties outright. But as far as other investors, veteran investors, I mean, for me personally, I like syndications because I've already owned hundreds of properties and had thousands of tenants, and it's just the point in my life where I am. I want to have more of a passive approach, but being part of syndication allows you to have closer to direct ownership without having direct responsibility. So you still get a great return. You've got a great asset class. I mean, everybody needs to have income producing assets in their portfolio, and like real estate, the reason I like it so much is it's a tangible asset. It's a tangible income producing asset. But if you wouldn't mind, any projects you have going on now, I know there's rules about this that you can't really get a lot out on a public forum. But I mean, I just want people to recognize there are still good opportunities out there, and particularly in syndications. And do you currently have something going on now that you're working on?
So right now we're in the early stages of identifying our next investment. We just closed on a large self-storage deal 2 weeks ago, so I'm kind of in between deals.
Mm-hmm.
But yeah, we're actively looking for a multifamily deal to do a syndication on. And yeah, to go back to your point about sometimes you can talk about it, sometimes you can't.
Mm-hmm.
That just has to do with the SEC regulations, whether you're filing as a 506B or 506C. Sometimes it has to be accredited investors. Sometimes you could do non-accredited investors. It depends on the offering. So as your listeners start to learn more and more about this, they'll find out what kind of buckets they fit in, what they're interested in. And yeah, I'm with you on the passive income. Like that's the holy grail of this whole thing. If you can invest passively, and I do as well, and live off your passive income, I mean, that's ultimate freedom, right? You can tell from my back of my wall here, like freedom's a big thing for me.
Oh yeah.
And passive income's a big part of that. So definitely, like I invest myself passively in other people's deals.
Mm-hmm.
Obviously I do the active stuff as well, but ultimately I want to be a passive investor, right? That's really where I ultimately want to be, but it takes quite a bit of capital to get there. Right now I'm working on the sweat equity side of things, but that is where I want to end up.
Yeah, you need a few more gray hairs like me, Chad. I don't know if that.
I'm getting there, man. I'm getting there.
What's interesting is I just was talking about that in a class I was teaching, that a lot of people what they're talking about is financial independence, which is they make their own money, right? They're not relying on anybody else to pay them a paycheck. They make their own money. That's typical entrepreneur. But then financial freedom is your money's working for you. And here's the difference. It's like you go from financial freedom to time freedom. So early years, you spend your time making money. And in later years, you spend your money making time. And that's the ultimate freedom, is to travel, the leisure, wherever you want to go. You have the financial wherewithal to do it and the time freedom to do it too. And I can tell you folks, Chad's doing it, I'm doing it, and you can do it too. And Chad, I know we're going to wrap this up, but I do have one more question for you, man. On a personal note, you got 5 kids, man. How do you do this? How do you balance everything and keep that smile?
Yeah, it's tough. Yeah, 5 kids is tough. They range from 17 years old down to a 1.5-year-old. I got 4 girls and a boy. It's a crazy house. And I'm not, truth be told, I'm not there yet. I would say I'm kind of out of balance right now. I'm very much into the career. Very much into the career. I've been at this for a while, 25 years now, I guess. So, definitely have weathered some storms. But what keeps me going, especially in real estate, is every deal I do, I know if I do it right, which is not too big of an if. I think, I can do it right. If I do it right, then I'm creating a passive income stream that should pay out in perpetuity and grow slowly over time. So I work really hard on a particular deal, get it up and running, and let's say that'll provide passive income for 5 years. But the trick is then to do a 1031 exchange, save some taxes. We won't go into that now, but you can forego the taxes on all those gains, roll it into a new property, get something bigger, and create a larger income stream. So I've got a bunch of these income streams that I've been working on that are growing slowly over time. And I know that that really motivates me. And I know right now I'm trading time for money, which is tough to do, especially with younger kids. And believe me, the struggle is real. And I'm sure some of your listeners, if they're trying to transition between like a W-2 into an investing job or as an entrepreneur, like it's tough overlapping those things. They know exactly what I'm talking about.
Yeah.
But like anything else, you got to put in your time and you will get the payoff. So that's what I'm working towards.
Awesome. Well, I'll tell you what, how are you open to other people? I mean, I guess people listening, if they want to participate in the syndication, is it appropriate for them to reach out to you, or how can people reach you if you have something like storage facilities you're getting that they may want to be involved in,
Yeah, and this is a really good point, because let's say for all of the non-accredited investors out there, if they want to invest in someone's deal as a non-accredited investor, which basically means you have over $1 million of net worth outside your primary residence, or you make at least 300 grand a year for married filing jointly. If you don't meet those requirements, you have to have a pre-existing relationship with the syndicator or whoever's doing the offering. So if you think you might do one of these investments in the future, it's really good to develop those relationships early. And they don't have to be significant. Basically, you got to have a couple phone calls. You got to really get to know one another. So I would, encourage people. They can reach out to me, reach out to other operators or other syndicators, get to know different people, because then once that deal does come available, you can say, oh yeah, I've already had a relationship with that person, so I'm qualified to invest in it, right? So the way they can reach out to us is either our website, csqproperties.com. They can follow us on Instagram, Facebook is just at CSQ Properties. I also put together a really good ebook for entrepreneurs on why they should be investing in apartments. And that can be found at passiveinvestingentrepreneurs.com. Entrepreneurs is plural. So passiveinvestingentrepreneurs.com is where they can get a free download of that book and really find out why entrepreneurs should be investing in this. Because I did that for 15 years, right? Or 17 years. And I really wish I knew then what I know now. I mean, you always hear that, but for entrepreneurs, create a separate passive income stream now while you're making money, because your business is going to go through cycles. You might even sell the business if you're lucky. If you're unlucky, it's going to go out of business, right? But definitely going to go through cycles. So if you have a passive income stream, it can really help supplement your income and keep providing that lifestyle that you and your family are used to. So that's kind of the people that I focus on helping.
Yeah. Well, that's a great explanation. So for those who are accredited, it sounds like primarily csqproperties.com is the place to go there. And if they're not accredited, it's passive investing entrepreneurs. Is that what it is? .com?
Yep.
Gotcha.
Yep.
That's awesome. Well, listen, man, I know we went overboard it up, but I really appreciate your time. This was an incredible podcast. And for those listening, I had to do a quick pause on the sound because a fire engine went by right as Chad was finishing up, and I'm trying to, okay, what do I do? So I gave him the symbol of continue on. He did an awesome job of doing that. It's one of the craziest things about podcasts is you never know what's going to happen. A dog barking outside, or in this case, a fire. He was honking and siren at the same time.
No problem.
For everybody listening, I know, I think I speak for a lot of people, Chad, when I say thank you, and for all those listening, thank you too for listening. And if you could do us a big favor, leave a review for the podcast when you're done. If you're driving, obviously wait till you get home, but leave a review. That's the juice that keeps the podcast floor going around. We really don't make money doing this. It's more of a community service. But what we get out of it is a lot of network and a lot of good information, like we just got today from Chad. So Chad, thanks again, man. I appreciate it. God bless you and your family. And same goes to all the listeners. We will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.